ASX in Sydney. Julia Lee from Bell Direct joins us now. Julia, down 1.7% into the second hour. What have you made of it so far?
James, so far the selling on the market has been pretty rational compared to what's happened in terms of the US stock market. Of course, overnight though, most of the action did come in the last few hours of trade. So just watching the close to get an indication of whether Australian investors are happy to hold their positions into the weekend or prefer not to hold into the weekend given the volatility that we've been seeing in markets. But look, it is red across the board. If we have a look at the top 20 blue chips on the market, every single one is trading lower. If we have a look at the top 50, well, only Mirvac and Newcrest Mining are trading higher at the moment. And in the top 100, it's only 4 stocks trading higher, 3 gold miners and Mirvac. So altogether, a pretty negative day on the Australian share market, although we aren't seeing the initial size of falls that the SPI futures was initially pointing to. And of course, we'll be keeping a close eye on the US futures to see whether we do see a lunchtime bounce or a lunchtime spiral.
Yeah, futures are a little bit down at the moment. I note Tokyo, a couple of minutes into their session, the Nikkei 225 down 1.75%. I'm interested in your thoughts, though, as you sort of alluded to, the idea of whether or not investors and traders are going to be comfortable holding their positions into a Wall Street session that really, as we've seen, can throw up anything. It would take some confidence, I would have thought.
Look, I think you have to go to the heart of what's driving markets at the moment, and that's US Treasury yields. What we saw once again overnight was a weak 30-year Treasury auction, and that follows on from a weak 10-year auction the night before. The reason why this is so important is not only are we seeing strong economic growth come through, which is a positive for markets, but we saw that budget package from the US government as well. And it looks like, the $517 billion spending that we saw last year is going to be surpassed in this year, and they're looking to spend $1 trillion and probably another $1 trillion in 2019. Look, the reason why that is significant is because that's a record amount of government spending in a non-recessionary period. So not only do you have the US Federal Reserve looking to normalise rates, but then you have the US government also looking to sell US treasuries in an environment where bond yields are already rising. So what we are seeing is an aggressive reaction in terms of the bond market, and of course that's had a flow-on effect to the equity market and volatility as well. Look, we have seen periods like this in the past before. The big question is whether we're just seeing a taper tantrum like we have in the past, or whether this is something much bigger, more like a volcano. But certainly in periods with high volatility, traders seem to love it. And of course, if you're a longer term investor focused, there are opportunities there as well.
And what's your view? I mean, obviously, it's vision's always better in hindsight. We don't have that yet. But I mean, do you get the sense that this is nothing more than a healthy correction, or do you perhaps fear that there's something more at play?
Look, I guess the biggest risk for the markets at the moment is a policy misstep out of the US. We see the Federal Reserve raising interest rates. And look, they're only a few months into probably a 7-year cycle of raising rates at the moment. So if they're too aggressive when economic growth isn't strong enough, that's a risk. But then, of course, at the same time, the US government, we've got the tax cuts, we've got the extra infrastructure spending as well at a time when economic growth is strong. So certainly the risks are out there in terms of the market. But in terms of the growth story, it is still looking quite good. So in terms of global growth and the commodities growth, these things are looking good. The thing that we're watching at the moment is the bond market and the bond yields, and I think that's going to give investors a lot of clues into what's to come. Having said that, there are a lot of opportunities on the market as well. This week, for the first time in many years, we've seen NAB trading at a grossed up yield of 10%. That's including franking credits. But, we haven't seen that for a very long time. And given here in Australia, we're likely to see rates on hold this year and probably into next year as well. I think there are certainly opportunities for income investors on the market today.
So is that where you expect to see, when support kicks in, is that what's going to lead the charge? Is it going to be those sort of sustainable yield offering stocks?
Look, I think if you're brave enough to go shopping on the market, and fortune does tend to favour the brave, you'd be looking at the good quality names with strong, stable cash flows and solid balance sheets, because the problems are stemming from the fear of rising interest rates. You don't want to get into a situation where you're investing in companies with a huge pile of debt in a rising interest rate environment. So look, the big four banks at yields of grossed up 10% for NAB, 9% for Westpac and Commonwealth Bank at 8% aren't looking so bad. Even if you have a look at Medibank Private or Eclipse, grossed up yields of around about 6% there. And some of the more specialised REITs that deal in childcare centres, FET, ARF, they both have grossed up yields of about 6%, but you'll probably find that many have the same idea on the market. I had a look to buy some of these this morning, and look, they're not falling as much as some of the growth names on the market and some of the higher PE ratio stock names.
You mentioned, and look, everyone's obviously talking about the bond market at the moment, yields, and you saw that the 10-year notes, I think about 2.88% at their height, settling around about 2.82. A lot of talk around 3% in the next few weeks, and that obviously could cause more ructions in equity markets. Your thoughts on the likelihood, in the near term at least, of actually seeing the 10-year hit 3%?
Look, I'm hoping we've seen the peak of the volatility at the moment, and while we'll see up and down movements in terms of the market, I don't think it makes sense for the bond yields to get too ahead of what the Federal Reserve is thinking in terms of the dot plot. So look, we are seeing new highs for this cycle, and that's causing a lot of volatility. But in terms of getting to 3%, I guess it's a matter of in what time period, and I'd be highly sceptical of it coming to 3% in a period of around about 1 month. So look, the market's just getting comfortable with this rising bond yield environment, and I think, look, this is going to throw up an opportunity given the strength of global growth at the moment.